I'm Nick Olson, Director of Private Wealth here at Cathmere Capital. I just wanted to take a couple minutes and talk to you guys about a question that we've been getting from some clients and also that we've been seeing in the news a little bit, talking about how great the S&P 500's done and why do we need to diversify if one thing has done so well for so long. And so we've put a couple slides together going back and putting some data behind this feeling that we have. We're calling it the S&P 500 envy. When we see one thing doing so well that we want to just emulate that and only be in that, well, what's the reason that we would want to diversify? And what does that really do? What is the upside and the downside of diversification? And what does diversification do over long periods of time? So we put together just a couple slides to go over, give you guys a couple minutes of things to think about, and hopefully answer that question. When we look at the slides and we're looking at this feeling of the S&P 500, why are we feeling it? And really it's just the last year to date, 10 years, it's been this theme of just S&P 500 dominance. Since stocks bottomed in 2009, the S&P 500, which is just large cap US stocks here in the US, has really been the golden child, if you will. That coupled with our innate just home country bias that we all have to own more of the things that we feel comfortable and we know about has caused many to just start questioning or just ask, hey, why don't we just own a whole lot more S&P 500? So I want to talk about that and really put some context behind it. That feeling is coming in from partly just because of performance, and I think that's a huge part of it. So year to date, the S&P 500 as of November 20th is up 23%. The global stocks, which have just done great as well, but hey, only up 15%, and bonds have done absolutely fantastic, but only up 8.8%. So all those just show that, yeah, they're all well above their historical averages year to date, but which one is the tallest and therefore perform the best? It's really the S&P 500. So then we go to, okay, what's happened the last 10 years? When you look at the last 10-year return, it's just been the same theme. Over the last 10 years, it really hasn't been any different. We've seen the S&P 500 annual return of almost 13.25%. Global stocks at 6.3 or 6.4, and bonds at 3.5 and change. So what is that in context to kind of normal returns over that 10-year period? Well, U.S. stocks are, and S&P 500 specifically, is about 5% north of where it typically is, 4 or 5% north of where it is. Global stocks are actually about 1 or 2% under where they typically are, and bonds are about 1.5% as well. So all those say that the last 10 years has been this, again, the same theme, which is why probably, we're 10 years into feeling, okay, why are we just not owning more S&P 500? So this happens a lot when we have one asset class or one thing that does just better than everybody else. And so we compare it to that. It's not a fun time to invest. And it's especially not a fun time when it's one of the main stock indexes that are referenced on the news day in and day out. So when you look and you say, okay, what do we do from here? Well, let's take a context of why would we ever own something else and why would we ever diversify? So when you look at diversification and we talk around what is diversification, there's two reasons why we diversify. The first and the primary reason we diversify is to really take a look and see, okay, are there other things that can give us a better return than what that one asset that we just talked about is, or that can reduce our risk across the board? When we look at those diversifying reasons, on the increased return or add more return to it, things like small cap stocks and international stocks, emerging market stocks, something called growth focused alternatives, those types of things typically give us a return enhancement to the portfolio by adding some of them into our mix. If you look at the other side of it, what is usually a good risk decreaser of risk? It's going to be bonds, cash, and other types of alternatives. So we have some good things out there that do that. The question is have they done it recently? And what we want to show you is kind of what has the S&P 500 done compared to a diversified portfolio when we add those things into it. So if I told you, or not if I told you, but let me ask you the question right now and say, what is your gut telling you to do? We just went over and we're looking at this chart over the last 10 years of seeing S&P 500 up 13.25%. You're looking at global stocks up 6 1/3, if you will, and bonds up 3.5. Does your gut, do you feel like you should add more to the S&P 500? Should you add more to stocks in general, global stocks versus US, or should you add a bunch to bonds? What is your gut telling you? What are you kind of feeling right now on what to do? Take chips off the table. So the nice thing is each day we can ask ourselves that question, and we do here. We ask what kind of allocation we should have, what should we be putting things in, and you have the opportunity to make a change of your portfolio. So we wanted to give you a little more context to what that's looked like, really since 2000, go back almost 20 years. We're coming up on, 20 years since then. What has it felt like to be a diversified portfolio versus the S&P 500? So as we kind of jokingly said here, diversification means almost always saying I'm sorry. So we chose some select groups in here. And just to put some context behind what you're looking at, the years are just some chosen for a reason years in here. The S&P 500 is that index that we've discussed. And a diversified portfolio is take the S&P 500, but rather than own just large cap US stocks, let's add in and own some small cap stocks. Let's own some international stocks as well. And let's take and add about 40% into bonds. By doing that, that gets us this mix of diversified portfolio. So from 2000 to 2002, the S&P 500 is down almost 40%. Your diversified portfolio does about half that in loss. It's only down 16. You should feel good, but what most of us probably feel after 2 years is, I lost money. Go from 2003 to 2007. The S&P 500 goes up 82% over that 4-year period of time. And diversified portfolio does fantastic, but it's only up 73, 74. So you didn't make as much. Again, frustrating. 2008 happens. The S&P 500 is down 37%. A diversified portfolio, even with great diversification, is down 24%. Trust me, you're not happy. You lost money again. Now let's take a big stretch. 2009 to 2017. S&P 500 goes up 259%. Diversified portfolio, only up 152%. So you're really mad you didn't make as much money. And then go 2018, last year. S&P 500 is down 4.5%. Diversified portfolio, also down 4.5%. You lost more money. Not even just lost money, you lost more money than the S&P 500. So how do you feel? We've chosen these reasons for a reason. You're probably feeling frustrated. You lost money. Here, I'll go through them. You lost money. You didn't make as much. You lost money again. You didn't make as much. And then you lost more money. So over that period of time, probably really frustrated. But as has been the case a lot of times, add all those things up. What happened? From 2000 to the end of 2018, diversification won, even though it felt like losing that whole time. So again, this doesn't mean this is going to happen every time moving forward by any stretch of it all. What it really talks about is us focusing on one thing or comparing ourselves to one thing, one index that's done well, especially the kind of shiny one that's done really well lately, is really difficult. But it also doesn't mean that you won or that it beat you or that is really what you should be gauging yourself against. So I just wanted to paint this really great picture of diversification. You might feel like you were having to say sorry and, I wasn't invested right. And, we didn't make as much. I lost more. But in the end, it can win. And it might do what we want it to do, which is reduce the risk or increase the return over periods of time. But diversification means you are going to look different than that one index. And that's actually a really, really good thing. Thanks so much for tuning in. I hope that this was really educational for you and answered some of your questions. If you do have more questions, please do reach out. We would absolutely love to talk to you about your portfolio, why we allocate the way we do, why we diversify the way that we do, and just your overall financial picture. Again, remember, investments is just a small part of the huge picture of your finances. Thanks so much. Have a great rest of your day.